The global financial system is hanging by a thread, and what you own right now might be completely worthless tomorrow. But here's what nobody's telling you about protecting your wealth when everything falls apart. Yes, they say the storm is coming, but what if it's already here, just slower, quieter, and harder to see? Prices keep climbing, debts keep growing, and every news headline feels like a new warning siren. Maybe you've caught yourself wondering, what if this time really is different? What if the system actually breaks? The truth is, collapse doesn't happen overnight. It happens in small cracks, in the confidence people lose, in the currencies they stop trusting, in the jobs that vanish. And before you know it, the world feels unstable. But here's the twist. While most people panic or freeze, a few quietly prepare. Not with bunkers or gold bars hidden in a forest, but with a plan. And that's what this video is about. How to protect your money, your lifestyle, and your sanity when the next collapse, or even just the next big disruption, hits. Let's get one thing straight right from the start. A total financial collapse, where money becomes worthless and society falls apart, is incredibly rare. The United States and most developed economies have taken punches before: the Great Depression, the 2008 crash, even the chaos of the pandemic. And every single time, systems bent but didn't break. The dollar didn't disappear, banks reopened, life went on. But that doesn't mean you're safe. Because even if the global economy doesn't collapse completely, your personal economy still can. A layoff, a crash in the markets, a frozen account, inflation that silently eats your savings. These things happen all the time, and to protect your money, you have to plan for what's probable, not just what's possible. So how do you do that? First, you have to understand the difference between collapse and disruption. Collapse is when the entire system stops working. Disruption is when it just stops working for you. Think of it like an earthquake versus an aftershock. Both can shake your house, but one destroys everything, while the other just knocks a few things over. Most people live their lives acting as if the aftershocks don't matter. Smart investors know that the aftershocks are where you make or lose everything. Now here's the uncomfortable truth. If you're relying entirely on paper assets, stocks, bonds, digital accounts, crypto wallets, you're trusting systems that depend on stability. Banks need depositors, markets need buyers, the internet needs power. If one of those breaks down, your access to your wealth can vanish overnight. We've seen it before. In Argentina, in Venezuela, in Cyprus, in Turkey, currencies collapsed. Banks shut their doors, and people who thought they were secure suddenly couldn't access a single dollar. So the question isn't if chaos happens again. The question is when it does. Where will your money be? Let's break down what happens to wealth when the system starts cracking. Cash, the most obvious fallback, loses value first. In high inflation or hyperinflation, your cash becomes paper. Gold might seem safer, but try buying groceries with a gold coin when everyone's panicking. Real estate sounds solid until tenants can't pay rent or governments start freezing assets. Even crypto, the supposed safe haven, is useless if the power's out. So what does that leave you with? Tangibility, real things, food, water, shelter, medicine, skills. When people can't rely on systems, they rely on what's real. That doesn't mean you have to go full doomsday prepper. You don't need to bury ammo or learn to milk goats. But you do need to build resilience. Resilience starts with liquidity, cash flow, the ability to keep moving when things slow down. One of the smartest things you can do right now, before anything breaks, is to build an emergency buffer. You've probably heard it before: 3 to 6 months of expenses in cash. But here's something most people miss. Even a small buffer helps. Studies show that just having $2,000 saved can improve financial stability by over 20%. It's not about the number, it's about the habit. Automate it. $50 a week into a high-yield savings account. Let it build quietly in the background. This is the foundation of every financial defense system. Next, lock in what's guaranteed while you still can. Right now, interest rates are high, and that's rare. When a recession hits, the Fed cuts rates, which means the free money you're earning on savings accounts disappears. So before that happens, consider locking in short-term CDs. They're federally insured, offer steady returns, and they protect your cash from inflation's silent theft. Once you've secured your liquidity, it's time to look at your debt. Debt is leverage in good times and a trap in bad ones. High-interest credit cards are the first noose around your financial neck when the economy slows. Paying them off doesn't just free your income, it protects your peace of mind. If you can, transfer balances to 0% interest cards, cut back unnecessary expenses, and get aggressive about debt elimination. Because in a downturn, every dollar you owe turns into a liability that can sink you faster than the market itself. Now let's talk about diversification, not the cliche version you hear from financial advisors, but the real-world version. Most people think diversification means owning 20 different stocks or a few mutual funds. That's not diversification, that's concentration in disguise. True diversification means spreading your assets across different worlds. You want exposure to cash, to commodities, to hard assets like real estate, and yes, maybe a small amount of gold or silver. Not because you're betting on collapse, but because you're hedging against disruption. But even that's not enough. You have to diversify physically, not just financially. Where is your wealth located? All in one country, one currency, one bank? If everything you own is tied to one political system, one central bank, or one legal structure, then your diversified portfolio could disappear with one bad policy decision. More and more investors are quietly moving part of their assets offshore, not to hide them, but to protect them. A second account in a stable jurisdiction, property in a different region, even dual citizenship. These aren't extreme moves, they're insurance policies for a globalized world that's becoming more fragile by the year. And if that sounds complicated or expensive, it doesn't have to be. There are funds, trusts, and international platforms that let you legally diversify across borders. The point isn't to escape your country, the point is to build optionality, the ability to move, adapt, and survive no matter what happens. Now here's where most people make a mistake. They prepare for collapse emotionally, but not strategically. They panic buy gold, stockpile food, or obsess over news headlines. That kind of fear isn't preparation, it's paralysis. Real preparation means focusing on what you can control: your cash flow, your skills, your network, and your mindset. Let's break that down. Cash flow is king. If your income depends entirely on one job, one client, or one source, you're vulnerable. Build side streams, even small ones. Rent out a spare room, offer freelance work, sell something online. These aren't gimmicks, they're shock absorbers. Next, skills. In a real disruption, skills become currency. People who can fix things, grow food, build, repair, teach, or trade have leverage. Ask yourself, what skill could I rely on if the systems around me stopped working for a while? Then, community. This one's huge. In every historical collapse, the people who survive aren't the loners with bunkers. They're the ones with networks, families, friends, neighbors who can barter, share, and protect each other. Your community is your real insurance policy. And finally, mindset. If fear drives your decisions, you'll always overreact. Fear makes people sell low, hoard cash, isolate, or give up on opportunity. That's why the smartest investors aren't doomsday preppers, they're radical optimists. Radical optimism doesn't mean pretending everything's fine. It means believing that even in chaos, there are chances to adapt, rebuild, and even thrive. When markets crash, strong hands buy cheap. When everyone's panicking, disciplined investors see opportunity. In 2008, those who stayed invested recovered. Many who bought at the bottom became wealthy. Those who panicked never caught up. So when the next downturn hits, don't freeze. Have your plan ready. Here's a simple checklist to think through right now. Build your emergency fund, even if it's small. Lock in short-term guaranteed returns before rates fall. Pay off all high-interest debt. Diversify your investments across assets and geography. Keep a portion in hard assets as a hedge. Protect your income by building secondary streams. Strengthen your community. Focus on mindset, not panic. And if you're an investor with significant assets, you can take it further. Move some capital into guaranteed instruments like annuities or treasury securities. Keep a portion in real estate that produces income, not just appreciation. Consider a small allocation, maybe 5%, in precious metals as insurance, not speculation. Then look at hedging. Options, inverse ETFs, or even short positions can offset losses in downturns if you know how to use them. Just remember, hedging isn't gambling, it's protection. For everyday investors, the simplest hedge is flexibility. Keep liquidity high enough that you can buy when everyone else is selling. the greatest transfer of wealth always happens during crises, not in calm markets. Think about it this way. Every collapse creates two kinds of people: those who lose everything, and those who see the cracks coming and quietly position themselves to catch what falls. You can't control what the economy does next year. You can't control who wins elections or what central banks decide. But you can control how prepared you are. And maybe most importantly, you can control your perspective. Because in every major economic disruption, the people who thrive aren't the ones who predicted it. They're the ones who stayed calm, stayed liquid, stayed diversified, and kept believing in the future. Fear is contagious, but so is confidence. So if you're watching this and feeling anxious about your savings, your job, or your retirement, take this as your wake-up call, not your panic button. Don't wait for collapse. Build resilience now. Start small, start today, move from worry to action. Because protecting your money isn't just about surviving the next crisis, it's about designing a life that can weather any storm. Watch the next video and see how the people who understand where the money's moving next always win. And if you're serious about staying ahead of that shift, hit subscribe. You'll want to see what's coming next.